people are getting priced out of their own home. In other words, even with a 3.5% or 4% mortgage, the cost to insure it and the cost for the property taxes that they keep getting reassessments are driving people to like, we can't take it anymore, and we're having to walk away.
Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, we talked about it last week, so I don't want to spend a whole lot of time on it, but my goodness, the grand opening of our Lincoln office on March 3rd, what a great time that was.
It was fantastic. We had probably about half our employees were able to make it down to the Lincoln location, and Dr. and Coach and legend Tom Osborne stopped by, actually signed. We have a nice picture of the stadium in one of the conference rooms. He actually signed that for us. I thought that was really nice. And Chamber of Commerce, we had multiple ambassadors and members of the Lincoln Chamber of Commerce stop by. We even had some folks from a charity we're now supporting down there, the City Mission.
The People's City
Mission has stopped by as well. So just it was a fantastic turnout. It was a great day overall.
It was. Now, in the meantime, David, I thought winter was in the rearview mirror. One last blast. I hope it's the last blast from nature for the season. But it knocked off our digital asset workshop. We had to move it. It will now be Thursday, April 9th. So anyone who was planning on joining us for the digital asset workshop, that has been moved to Thursday, April 9th. Of course, that's 6:30 p.m. right here in the Midwest Learning Center at Retire Smart. More on that as we get closer to that date. David, State of the Union address by the 47th President of the United States was this past week. What'd you think?
I thought he did a pretty good job. Obviously, people on one side of the political aisle will disagree versus people on the other, but it was the longest speech, I guess, in history for such an event. And I guess technically this was a joint session of Congress, not because
right.
He hasn't been in the office but a couple of weeks. But
I think he surpassed Clinton. Had one or two really long ones, but I think Trump. I
thought it was actually entertaining and covered a lot of ground. And but he was not too rhetorically heavy. He was staying down the lane of what probably 75 to 80% of Americans would agree with on the issues that he talked about in the speech. I thought that was strategically powerful. In fact, CBS put a poll out the next morning after surveying their viewers and we know typically the network news does not typically lean to the center right or to the right. Typically, 76% approved the speech and thought it was
three-fourths approval.
Yeah, so that just tells you it was very well received, and so there was a lot of tidbits in there. He even kind of petitioned Greenland, hey, if you want to come on board as our 51st state and make a vote, you could come. Covered everything from the Panama Canal to issues, etc., and then honored several kids. There was a nice moment when a young man who's been suffering from brain cancer was made an honorary member of the Secret Service. His dream was to be law enforcement. So I just thought it was they just enough of the right emotional touches to go in with some poignant data points. So
part
it was
policy
good.
Discussion, part pep rally,
and delivered in a way that was impressive. No notes, just stood there. He actually had a book, but it was closed. Never opened it once. Wasn't really working off a teleprompter at all. Just almost from the hip and delivered it pretty well.
Hey, you mentioned the Panama Canal, and we touched on it briefly in recent weeks, but I guess this is getting serious. Now, we're not talking about sending troops in necessarily, but American businesses are positioning themselves to assert themselves in the Panama Canal. Am I reading this correctly?
So first and foremost, you understand is wars used to be fought just with, you had somebody in power would conscribe their military, whether it was forceful or voluntary, and then send those folks out to battle and die, et cetera. The wars are now fought digitally. They're fought economically, and so you have to be playing ball on this level of playing field. So the first thing that former Senator Marco Rubio, who's now basically Secretary of State, did was fly down to Panama and have a meeting with the powers to be there. So again, if you don't know, we built the Panama Canal and basically had a 99-year lease, right? And then we turned it over as we promised to the country of Panama.
1970s, the Carter administration, I think, is when that happened.
However, they have allowed Chinese influence to basically build up a ton of infrastructure, and so China was at the end of their leases. Well, being Trump being the economic mastermind that he is, he negotiated with several American corporations and investment firms, the biggest being BlackRock, and this is the biggest infrastructure investment to date in their history, in their behemoth. And basically now American companies are controlling ports on both ends of the canal and controlling a lot of the infrastructure there to basically make sure Panama understands, hey, play ball or we'll shut down the economic activity that goes on. And again, it's just another way of economic warfare, if you will. We're going to control things, and China is our biggest enemy that we have to fight economically right now if we want to thrive as a country.
David, we record this show on Wednesdays. The job number for February will come out Friday. But in the meantime, right before we sat down, you sent me a story about what ADP, the payroll company, is seeing in terms of jobs for the previous month. Not a good number.
No. So an ADP puts out a private payroll report, and that comes out, as you said, every Wednesday prior to the federal government's official report from the prior month. And it showed basically they were expecting about 146,000 jobs. 77,000 is what were created. Right?
Half of what was expected.
And so that was pretty dismal. Again, it doesn't always align, so we'll see. But obviously, we know job losses are mounting. February was the largest job cuts across America. Over 138,000 jobs were cut in the month of February, largest in over 2 years. And we are seeing job openings decrease, and we had that chart up just a week ago. So that is showing you that we're economically going to go through a little bit of a season here for sure.
All right, David, I want to throw 3 headlines at you. They all deal with the housing market. All right, the first one's a CNBC headline: pending home sales drop to the lowest level on record in January. David, it doesn't seem like it was that long ago when you could put your house on the market in the morning and by close of business, you sold it for probably 10% more than you were asking.
The average listing now is having to come off between 8 and 12%. But the amount of listings is scary. And so we had the lowest, now this is for January, the lowest sales for a January. So not just in history in general, but in a January. On top of that, we actually had the highest cancellation rate ever recorded in January. Over 41,000 contracts that were supposed to close in January did not. That's just a tick below 15% of all transactions nationwide for that month. And that was the highest cancellation rate ever seen in a January. So in other words, people that said yes, signed a contract, put up an earnest deposit, decided for one reason or the other, you know what, we're not going to go through it. We're not going to close even if we lose our deposit. And so we saw numbers like that in December and November. We've talked about the uptick in December. It was over almost 17% of contracts canceled. And so people are nervous. Should I make the commitment? Well, obviously, mortgage rates are much higher now than they were just a few years ago. And so people are having, they're getting that kind of cold feet right before they go to the closing table.
Well, you sent the team a chart from your former home state of Florida, the homes for sale inventory. That is the highest on record. That is the highest ever right now. They're not moving. The homes aren't selling.
No, they are not. And again, I own property in Florida. My oldest son still lives in Florida. I'm an investor down there. But the amount of listings that have come online just is skyrocketing, and that doesn't show any signs of slowing down. And then you're going to see a great reset in some of the markets like South Florida. You go down to Miami in particular, some of these condos that flourished for a while, they're getting reassessed, Chip, and people are getting priced out of their own home. In other words, even with a 3.5% or 4% mortgage, the cost to insure it and the cost for the property taxes that they keep getting reassessments are driving people to, like, we can't take it anymore, and we're having to walk away. And so we're seeing an uptick in delinquencies as well. I think I sent you a chart referencing
Freddie
basically,
Mac, one of the agencies, government-backed home loans.
So delinquency rates, serious delinquencies, are now higher than they were in 2008.
Well, then now that sets off an alarm. I mean, it was home loan delinquency that triggered the Great Recession. Is that what we're looking at here?
Well, it could be, because, again, it's so different today. Back then, you had a house that was dropping in value because things just got crazy. It was easy money from 2003, 4, 5, and that created this massive rush up in values of real estate. So you owned a home in 2008 that might be worth, say, or you had a mortgage for $300,000, but the house was actually only worth $220,000. You were underwater. So people walked away because they were negative equity. Like, I'm not going to keep paying this mortgage. So they did what's called, mail the keys back, jingle mail, or strategic defaults, and they just walked away. Today, people, even though they have a low mortgage rate, are having to think about walking away or not paying it simply because the escrow payments I just mentioned, the property taxes and insurance, have gone up. So property taxes are up nationwide. It's approximately 38% in the last 5 years. Homeowners insurance is up 65% over that time period. So you've got basically a 100% increase in the escrow payments. And some people, it's bigger than the actual mortgage themselves, and they cannot afford the house. And so we coach young people, look, buying real estate, Chip, is a great investment. It's a great first step in getting yourself financially stable, because over a long period of time, the house will double in value. But there's going to be pockets and times where that doesn't work out. But when you buy the home, you don't want to be what we call mortgage poor or cash poor. Can you understand? It's more than just principal and interest. It's property taxes, which we all know about here in Nebraska, right? It's insurance, and it's maintenance, which you need to be budgeting in for your home. I mean, I have to spend almost $30,000 a year to live in the home that I live in. I don't have a mortgage, right? And it's not that you've been to my home. I don't live in a Taj Mahal, but property taxes are about $15,000 a year. My homeowner's insurance is about $7,500 or so a year, and then maintenance and upkeep on a house of that size. It's just, and so people don't think this through. So you're going to set people that realize I can't do this, and they're going to walk away, and we may see a bit of a housing correction. In fact, I'm predicting 7 to 9% reduction in nationwide housing prices in the next 12 months.
Well, we'll keep an eye on all this. I'm going to get greedy and squeeze in one more story this segment, David. Now, you sent me earlier in the week, you sent me a bill that's been introduced in the Senate by Ted Cruz. Now, you often say, folks, don't worry, I read and master the tax code so you don't have to. I'm going to ask you to do a similar exercise here. Spare me and our audience having to actually read the 16 pages of the bill, but tell us about the Capital Gains Inflation Relief Act. To me, that sounds good. You said it might be a nightmare, though, for tax preparers.
Well,
what's going on?
It will be. In other words, so it is. On the real premise is, if you bought, let's say you bought an investment property. I've owned many, right? I buy a rental house for $200,000 and it goes up in value and I want to sell it for $400,000 years later. I would pay basically a capital gains tax on that difference, $200 to $400, and that's called the capital gains tax. You're paying on the gain. So what he's introducing is the inflation adjustment of your cost basis. So at $200,000, if I held that and inflation was, say, 3% a year, and I held that property for 20 years, well, my cost basis would now reset each year by that inflation number. So my cost basis would be $400,000 20 years later, and I wouldn't owe any capital gains. However, it's going to get convoluted because inflation moves around every month. How are you going to calculate the day you sell it to get the actual CPI or whatever we're going to use as the metric to prove your inflation number? And then we also have to, and for preparers, they got to factor in what's called depreciation, right? You get depreciated on investment property. Then we call recapture. If you don't own the property long enough, you have to recapture that as income tax. And then you're going to have it would be it'd be an uptick in fees to accounting firms. But it would be complicated to figure out. But it would be a net benefit to the investing community.
It's a good thing for the taxpayer, but it might be a real headache for the number crunchers that have to nail it down.
And so maybe what they need to do is, and again, when they introduce these bills, right, they first have to get out of committee, then you can you mark them up, and then if both houses take it up, it has a chance to become law. So maybe simplify it that it just, we're going to go with the January 1 CPI number each year, or just the month that you close in the year over your numbers, what we're going to use, et cetera. So how would you calculate that, prorated, all that? But I think it's a good thing. Again, I just think that, taxation is theft in most circumstances. So I'm for anything that, levels the playing field for the American taxpayer.
Up next, he's an Air Force veteran. He's also a veteran of the financial industry, and now he's part of our team at Retire Smart. Financial advisor Tim Herrick joins us next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. We're putting together another class at Retire Smart for the general public as well as clients. It will focus on federal employee benefits, a topic of great importance to members of the military and other federal government employees and retirees in our community. With us today is our resident authority on federal benefits. David, please welcome our special guest, financial advisor Tim Herrick.
Thank you, Chip. Yeah, for the first time in the studio, we have one of the newer advisors on our team. He's been with us a while, but he's got a wealth of experience. He's been in the industry for quite some time. Actually worked at one of the big box ones, as we call it, retail shops. But prior to that, and reason we have him on today is he served our country, U.S. Air Force veteran, and also worked in various government agencies and defense contractors, and is leading a class we'll be talking about on federal benefits. So welcome, Tim Herrick, to the show.
Thank you. Glad to be here.
So we're glad to have you. So just give our audience a little bit of background on kind of you. You started in the Air Force, and now did you go to college prior, or did you go after, or tell me how you got in there?
I joined the Air Force when I was 21 years old. I come from a long family of service to our country, and I served in the United States Air Force for 5 years, where it took me to Afghanistan, which was a very eye-opening experience. And during my active duty enlistment, I did go to school and finish up one of my college degrees. Following my completion of my enlistment, I was a defense contractor with various government agencies for about 7 years, where it also took me to Iraq for a period of time. And I ultimately decided to take my career in a different direction and kind of servicing my community in the financial planning realm beyond that of government service, if you will.
Yeah, and then you've had some great experience in that world, and we were really glad to get you on board here at Retire Smart, and you have graciously kind of taken up the helm and heading up our federal benefits class. We're going to be having our first version of that coming up in the second quarter this year. I don't think we have the dates 100% solidified today, but we'll make sure that our listening audience knows about that. So can we just talk about, like, because you do have experience both from the employee side and the advisor side, talking to folks, helping them understand, because when it comes to federal benefits, one, they have a lot more benefits than a lot of them even realize. And two, there's some confusion around some of those benefits, what starts when, continuing. Can you talk about just how you're able to help just kind of with the holistic planning approach, lay all these things out for them?
Absolutely. It first comes down to asking those important questions and giving them the education on the retirement benefits that they don't know that they had. You said it perfectly. Government employees are so good about, working their job as much as they can, but they don't do much investigation as to what their retirement picture is going to look like. So having worn both sets of shoes on the government service side as well as the financial planner, I have a very unique insight as to what issues they're going to be facing and what kind of solutions we can provide them, both in the short term and long term, so they can focus on their current work.
Well, and I think obviously there's a lot of, let's just call it anxiousness with some government employees right now with what's going on in the current state of affairs with DOGE, et cetera. We know we had about just under 80,000 voluntarily accept the opportunity to walk away early or get paid through September of this year. We've actually already started working with several of those folks, but you've got about 200,000 others that are getting dismissed. And again, it's not necessarily that the employee was a bad person or a bad worker. We want to make sure people understand that. It's just that our government has unfortunately proven not to be the most efficient apparatus operating out there, and they've lacked transparency, which the American taxpayer, I think, finally got fed up with, and hence the results of the election we had, right? So what would you tell someone out there who's working for the government, enjoys their job, but is anxious that their job may get clipped just because cost cuts are inevitable? And if it was a company, these cuts would probably have already happened, right? Layoffs happen. Right. Companies have to maintain profitability or they can't exist. And we're going to see some of that in the way the federal government's run. So what would your words of wisdom be to those people that might be a little anxious right now?
Well, obviously the federal employee, they have no control whether or not they get to keep their position or not, but the voluntary early retirement authority provides them the opportunity to retire early. But the question comes down to, have they done the due diligence about analyzing their current situation? Are they in line to reach their retirement goals? And what they're doing on the outside in their individual financial planning is kind of makes that situation a little bit less stressful, if you will. That can they retire if they want? Are they being forced to retire? What's the next venture look like? Can they work if they want to versus work if they have to? So it ultimately starts with the data collection and asking those important questions. There is a little bit of homework that the federal employees need to do on their end to kind of understand their situation. And that way they can kind of map out their retirement picture going forward. It kind of takes the stressor off the table, if you will, so they can, again, focus on the work they're doing, because federal employees, they know this, that they can't control what the government does or doesn't do on their behalf.
Well, and most of these folks are going to qualify for some form of pension benefit. They're going to have a monthly check basically guaranteed for as long as they're here typically. And there's some different variations of that depending on when and what department, et cetera. But the other thing is most of them have been pretty diligent savers, frankly. They're usually they're very diligent. The ones I've worked with and helped they're budget conscious. They're smart. They put money away. Now they have a vehicle similar to most people's 401k called the TSP or the Thrift Savings Plan. And can you talk about the advantages and the disadvantages of that, right? It's a pretty decent vehicle to help them accumulate dollars while they're working, but it's really not a very good decumulation vehicle, is it?
Correct. The thrift savings plan is attractive to a lot of federal employees due to the fact that they have a number of menu options afforded to them. The downside is you're taking out the personalized financial planning guidance. You're kind of putting people in a cookie cutter situation. And there's no education, to my knowledge, both on the federal service side or what I've worked with federal employees coming out into retirement, is that they don't know what to do and when to do it and how to decumulate, as well as the tax situation going forward. That government employees are very good about stocking away those funds for that rainy or retirement day, if you will, but they're not given that individual necessary guidance about what the retirement picture is going to look like and how to decumulate and how to ultimately put them in control when it comes to the tax situation as well.
Yeah, I think it's really important. And so what we're talking about in the decumulation phase is like when we set up someone's retirement and they had money, say, in a 401k or a 403b, basically, a lot of these vehicles, you can set up where you would like to take distributions from. So in a 401k, you might be able to set up a bond fund that was just a lower risk, short-term treasuries, and that's where your income comes from. The TSP does not allow that separation. So if you were allocated into like what's called the C fund, which is basically the S&P 500, and maybe the G fund, government bonds, et cetera, and you take a distribution, you may be taking it from the stock fund when it's the absolute wrong time to be doing that, right? So there's huge advantages potentially if they were to roll that into an individual retirement account, an IRA. One, from the income distribution planning standpoint, right? Because you can take it from the right assets to the lower risk assets, so you can helpfully beat inflation. But two, you can start doing tax planning as well. Things like Roth conversions, QCDs, et cetera, that you cannot do inside of that TSP, right?
Correct. And a lot of federal employees, they get in the habit of basically set it and forget it. So they could be sitting in the wrong fund for 20 years versus the benefit of working with an individual financial advisor is they know how to adjust their financial plan based on their life circumstances, their changing goals, as well as market conditions. So we definitely bring that tailored situation into the financial planning to give them that peace of mind for the future.
Yeah, and a lot of those folks end up sitting in a chunk of their dollars in what they call the G fund, and that hasn't really performed very well, has it?
No, the G fund, they will basically put in there at their own detriment, if you will, because it does provide the warm and comfortable situation for a year or two, depend upon market situations, but they often don't revisit it and allocate appropriately based on their individual
and it's going to change how it returns. Drastically is going to change the performance based on how interest rates change, right? And we've had some volatility the last 4 or 5 years in interest rates, and we're probably looking for more of that here in the near future, right?
Absolutely, absolutely. I've known many people that have sat in the G fund to their own detriment for 15 to 20 years because they just didn't revisit it, and it definitely put their retirement picture in a little bit more jeopardy than what they would have thought.
Yeah, sometimes when we show people what they could have done if they had just a portion, half even in like the C fund, and then they have the small caps and international and the I and the S funds, et cetera. They just don't know. And again, no one's taken the time to show them how to allocate while they're working. And that's one of the things you're great is whether they're still working, plan on working for another 10 years, or at that precipice, like maybe they're going to have to make that decision here or retire early or not, you can help them out. And of course, you've been a great help with all the advisors on our team. So looking forward to the class. Again, we don't have the dates, I think, set up. I think you're going to be teaching that somewhere in the second quarter. Is that right?
Yes, that is correct.
All right. So to be looking out for that class, you'll just go to retiresmartnow.com, look on the events page. It'll be listed there. We are out of time for this segment. So Tim, thanks so much for stopping by the studio.
Absolutely. Happy to be here. Thanks for having me.
All right, Chip, what do we got next?
You have questions? David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. Another round of questions from our State of the Market address audience. And the first one is about Doge dollars. Should dollars rescued from waste, fraud, and abuse by Doge be given to taxpayers or used to reduce the debt?
I think it should just go to reduce the debt. We don't need to send any more money out to people. That is inflationary when you do it. When people get money they haven't actually earned, they spend it on, it changes whether they're paying for necessities or not, and wants become needs, et cetera. I would much rather think that we should simply cut the spending, cut the debt, which is really what we're trying to do, and get us to a balanced budget and a reduction in our deficit every year and a reduction in our actual debt every year. And I think that would make the American taxpayer happy.
Next question, David, is about cryptocurrency. What is your 1 to 3 year outlook for cryptocurrencies? Which ones should we avoid? Which ones should we invest in? Now, I'm sorry, David, I couldn't help but sort of folding into this question something you sent the team. Poor Jim Cramer. He's been taking it on the chin lately for some of his predictions. Well, he's declared that crypto is dead. So now a bunch of wags are out there saying, oh, go all in on crypto now. But how do you see it, David?
Well, I would just tell everybody, take caution. I'm not giving anyone any advice on how to invest in crypto. I would encourage you to come to the digital asset class that we just pushed out till April here, that Brad Starkin, one of our advisors who's certified in these matters, can talk about. But again, cryptocurrency, digital assets, there's various forms of them. However, I would just tell you, basically this last weekend, Trump talked about the Federal Reserve is now going to have a crypto reserve to a portion of it. So that quickly spiked the price of Bitcoin, Ethereum, Solana, and a few others. So if the government is going to be purchasing and restoring these, that's probably where I would lean. I personally, just full disclosure, I own about 14 different versions of crypto assets, et cetera, but it's not something we highly recommend for folks. We do utilize some Bitcoin through an ETF form in one of our portfolios for our clients, but it's a very small sliver. Again, this is a pure speculative asset. And you need to understand, that's what the class is for, by the way. You can understand how these digital assets are actually utilized. And so Bitcoin is more of a store of value, whether you think it's a store of value versus gold or the dollar, that's your call. But some of these others are what's called smart contracts, and they're going to revolutionize the accounting world and how supply chain management is managed, and that's going to create a massive amount of efficiency. But the other side of it is you need to understand, we talked about it, how much money's been stolen in crypto, and it's in the billions and billions of dollars. Where do you buy it? Is it a reputable exchange? Are you leaving it on the exchange? Or are you going to store it? The whole point of it is to have a digital asset nobody can command. So I have a private wallet, with encrypted and locked, that it's not on an exchange. I have it in a safe. And so there's a lot to understand. I would just highly recommend you go to that class.
Well, speaking of crypto shenanigans, you also shared with the team some Forbes magazine covers. There they are on the screen for our YouTube channel. Sam Freed and some of these, the MicroStrategy guy.
So Michael Saylor was just on the cover of Forbes.
The kiss of death there. You appear on Forbes, and then you're in big trouble. You're indicted or in jail.
So the other ones we have up here, so you've got Sam Bankman-Fried. You have Elizabeth Holmes, right? Yeah. And her healthcare revolutionary company that it was all fraud, right? Well, Michael Saylor, just so you know, he runs MicroStrategy, this company that's lost about $1.6 billion in its existence for 25 years, never made money, ran all the way up with a scam in the dot-com bubble, went all the way back down to nothing, and has made this run again. And look, he's just buying Bitcoin. He takes your investment in a stock. He offers convertible bonds. People buy the bonds. He takes the cash and then buys more Bitcoin. So basically, you're paying about 1.8 for Bitcoin when you could just pay 1. You could just buy the Bitcoin outright. Why would you pay 80% more owning his stock? And again, I would highly encourage people to be very cautious if you're an investor in that particular equity. But again, I'm not making any recommendations on the air.
David, let's move on to precious metals. Question is, what is your 1 to 3 year outlook for gold, silver, and other rare metals? Are there rare metals on which we should focus in the near future?
Again, absolutely. And we have the majority of our clients own a portion of their assets into the commodity space. And inside that commodity space, we have soft metals, we have precious metals, et cetera. Gold and silver being the two primary ones. I will tell you the area that is very interesting now is you're going to see a massive push back to nuclear energy. Imagine that, something we've had around for 60 years, but we've run away from, and now people are realizing, well, wait a minute, this is green energy. So the green community should be pushing for it, because once you've done all the CapEx expenditures, the only cost is the enriched uranium, and so you have to buy these precious metals. But there are other metals, rare earth minerals, et cetera, that go into components to make certain things like in your iPhone, et cetera. But gold and silver are absolutely going to do well. In fact, gold over the last 12 months has outperformed NVIDIA. I want to say that again. People might find that shocking. Yeah. Gold for the last 12 months, as of this recording today, has actually outperformed the stock NVIDIA in the last 12 months. So I would tell you that, yes, we do own gold and silver, and I think gold's going to continue its run in the near term. And can go higher. But again, gold is very, very volatile, Chip, has a beta of 20. So it's going to be almost 20 times more volatile than the stock market itself. and it's just a store of value relative to the currency you own it. Now, here in the U.S., you can only own it in U.S. dollars, at least under our laws, but there are people that have dollars outside of the U.S. and can own it in other currencies. It's just a store of value. It's a hedge against the devaluation of all the fiat currencies.
You're saying gold is a volatile investment. I always thought gold was supposed to be more stable. Old reliable gold when everything else is going
So
crazy.
if we go back to 1980, you would have been better off buying the S&P versus gold. Okay. But if you would have bought gold just over the last 5 years, you'd have been better buying gold than the S&P. But again, you see these commercials, and we want to caution people. You need to have a portion of your assets. You do not want to have 100% of your IRA in gold or silver. And then again, make sure you understand these people that advertise this stuff on the news and all that stuff, they're going to charge you storage fees, and it's very expensive. We had a client lose over 40% of the value of their account when gold went up 20% during the time period. So take caution.
David, let's get in one more question. This one's about Social Security. Do you think no tax on Social Security might be enacted in 2025?
No, not in 2025. Will it get passed and will it be retro this year? Not likely. It may get passed into the bill, but would most likely start next year if that in fact comes law. But here's the thing. Social Security is not taxable now if you actually understand how to plan your retirement. Social Security is only taxable if you have other taxable income. So one of the things we're able to do is for about 40% of our clients, we're able to project them to a 0% tax return, a 0% tax liability every year throughout their retirement once they're to their mid or early 70s. And the primary vehicle to do that is one of our most popular tax strategies is Roth conversions. We call it SRI. We take that IRS, flip it around, strategic Roth integration. If I can move all your dollars, if you've got $1 million in your 401k when you leave work, and we can slowly pay the minimal amount of tax as we can before you have to start taking what's called required minimum distributions and move those dollars to your Roth. There's no required minimum distribution for your Roth, but if you take the distribution from the Roth and you follow the rules, you're over 59 and a half, have the account in existence 5 years, etc., that distribution is most likely going to be 100% tax-free, and it is not going to calculate into your Medicare tax or your Social Security tax. Therefore, your Social Security is tax-free, and you will not have to pay penalties for Medicare Part B and D. Again, if you don't understand this and you've done well, it's a saver's tax. It's a penalty for success. You may end up paying as many as 8 taxes on one distribution from your IRA. You don't know what you don't know.
Up next, what pizza franchise introduced stuffed crust pizza 30 years ago? And who was the celebrity pitchman for this revolutionary innovation? Chew on those questions. See what I did there? Chew on those questions during the break, and we will provide the answers on the other side. Stay tuned to Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. But did you have a few minutes to chew on the trivia questions there? All right, here's the CNBC headline, folks. Domino's Pizza finally launches stuffed crust to keep customers away from rivals. Well, it was 30 years coming. Now, David, you have some history. Domino's is in your life, in your Forrest Gump life of having done so many different things and being a serial, as you call yourself, serial entrepreneur. This is where you got started in the pizza business at Domino's in Orlando.
It was. I was going to school in Orlando at UCF and started delivering pizzas at night and ended up in their management program and actually became manager and set multiple world records for Domino's for pizza sales and highest profit margin in their history, et cetera. And when I was 19 years old, that's one of the things I got so involved in understanding how the tax code works is I was presented a Rolex watch. We tell this story all the time with Domino's Pizza embedded in it, but I actually didn't work for the corporation Domino's. I worked for the local franchisee. And as gentleman John, but the corporation is who presented me at a big convention this Rolex watch, and it literally had Domino's Pizza embedded in it. Become a collector's item now, but I didn't claim it on my taxes. I was 19 years old, right?
Uh-oh.
And about 5 years later, that caught up with me, and it basically cost me more than the watch was worth in taxes,
Yeah.
penalties, interest, et cetera. That was my very first run-in with understanding why the tax code is so important. But yeah, I actually went through the process, and I was going to franchise a Domino's Pizza. And basically I had the location on the called Palm Coast, Florida. It's near St. Augustine, where I was going to open my own franchise. However, Tom Monahan, the original founder, sold out of Domino's Pizza, actually sold it to Bain Capital, Mitt Romney's group. And he's a pretty good philanthropic guy. He gave $750 million after sale to the Catholic Church. I don't know if you knew that, Catholic Charities, et cetera. However,
Monahan, you're talking about.
Yeah, Tom Monahan. Yeah. And he also
Ave
owned
Maria University.
He
I
also
think,
used to own the Detroit Tigers, and so
Yeah.
when you were a manager, you were actually allowed to wear a Detroit Tigers hat if you didn't want to wear a Domino's hat. Anyway, it was all these funny rules, but. I realized when they took over, they changed the advertising rates. As you can imagine, a company buys a company. We're going to up what the royalty fees are and the advertising fees to the local franchise.
Your own franchise.
So we did. So we started our own. It was called Stadium Pizza. We ended up opening 4 different locations and built a very successful chain in the Central Florida area, in Kissimmee, St. Cloud, and South Orlando area. But anyway, we ended up doing public lunch for 19 public schools. So we were a pretty high volume place. But as you've heard me tell many times, the story of missing one of my children's birthday parties,
right.
My own son's birthday, because the restaurant business requires a heavy lift and a lot of work. Yeah. It was time to sell those, and we did. And that's how I ended up in this industry. I got recruited from the guy who was my stockbroker at the time at Payne Weber. Mm-hmm. But anyway, yeah. So Domino's Pizza, I thought it was funny when I sent that story to you, because the celebrity, let's answer the trivia question.
Oh, yeah, the other trivia
features
question.
in the article there is none other than Donald Trump was the celebrity they targeted to sell their stuffed crust pizza. This was Pizza Hut that we're talking about. They launched stuffed crust pizza 30 years ago, and then Papa John's has had their version, etc. And so Domino's had resisted it, thinking it was a bit of a gimmick, and now they've spent the last 3 years testing this product and then training all their franchises. So Domino's this week, if you don't know, just launched a stuffed crust pizza. Now, I'm a bit of a pizza snob, as you know.
Yes.
We've actually done rounds here every Friday. I've bought pizza for the teams several times each year, and I know who your favorite is, right? And we've had this contest. We have our own March Madness. It seems
have some strong
selecting
opinions
who's the best pizza. Yeah, and I have different versions of pizza that I like. But anyway, it's just a fun story. But yeah, Donald Trump was the pitch man.
So Donald Trump was the pitch man for Pizza Hut to start the stuffed crust pizza. All right. We still have a little heavy lifting to do, David. You sent this chart around to the team, and you said, I don't like any chart that says since 1999. This is a ratio comparing U.S. large caps to U.S. small caps. All right. Decode the jargon for us and tell us why you thought this chart mattered to the team.
Yeah, and this comes to us from Charlie Bello, who's kind of one of the chief investment operators for Creative Planning, which is a nationwide firm. And he puts out some great content. But basically, this is telling you that large caps are overvalued relative to the rest of the market.
What's a large cap?
So large cap is the bigger companies. These are companies 10 billion or larger in size typically.
Cap referring to capital?
Yeah, okay. Exactly. How big the valuation of the company. And we haven't had this far of an outreach where it's all large cap that's doing all the leading, since you got to go all the way back to the dot-com bubble when the stocks that led the way. And so that's telling you that there's some imbalance in the system, and typically there's going to be a correction. And if you study history, we like to do, it wasn't really good the next 3 years after 1999, was it? It was the only time in anyone listening's lifetime we had 3 consecutive double-digit loss years on all 3 major indices: the NASDAQ, the Dow Jones, and the S&P. All 3 had double-digit losses 3 consecutive years. The last time a chart like this was printed.
So what do we do, or what should policymakers do, or are we just at the mercy of the markets on something like this?
Well, you should have somebody who's proactive in their approach. So
or what
your
should I
asset
do
allocation,
as an investor is what I should really be asking.
Well, you're going to be covered
Especially as a
because our
retiree.
portfolios here are automatically going to be reallocating and taking risk off the table when we see things like this. But so for our listening audience, they should basically understand is, listen, if you've looked at your stocks, your portfolio, and we have people come in that we call DIYers, do-it-yourselfers, and they own Amazon and Apple and NVIDIA, and they've owned them for the last 5-7 years, Meta, Facebook, et cetera, and think, oh, I'm a genius, they've done well. Well, everything reverts to the mean. It just does. And so at some point we're going to correct, and we've seen that correction already happen in some of the stocks. I mean, NVIDIA just 3 months ago was a $150 stock. It's sitting, as we're recording this, around $114, $115. That's a pretty severe correction. Well, if that starts to tumble through all the large caps that have led the market over the last 5 or 6 years, you're going to have a reset in value. And if you're in these passive indexes, in fact, we had Tim on earlier, right? Everybody that's investing in that TSP, those are just passive indexes, right? And so those are going to get clobbered like the C fund, because the passive indexes now are so heavily weighted in these large caps. The top 10% of stocks in the S&P 500, or this top 39% of the weighting is the top 10 stocks. So if those stocks correct 20%, what's going to happen to the entire index?
Oh, it's going down.
Yeah, and we'll be in a bear market
because they
most
were
likely.
carrying it all along. So if they go down,
Yeah. And so typically what happens then is you get a reset, and then you'd want to be investing in small caps and mid caps and diversify. So it's just about understanding your risk allocation, how to diversify your portfolio so that you understand the risk you're taking. It's one thing if you're 25. It's another if you're 65 and you stepped into retirement 3 weeks ago. How much risk are you taking? How much risk are you comfortable? And I always tell people, if you can't sleep at night, you're probably in the wrong stuff.
Speaking of NVIDIA, you just mentioned it, and in the previous segment, you referenced gold versus NVIDIA and so forth. Let's put that up on the screen for our YouTube listeners and describe for our radio listeners. Let's get into the numbers a little bit, David, and tell us exactly what's going on here.
Yeah, so NVIDIA is up. If you went back, and this is, I think, 2 days old that we've got the screenshot from, but basically, NVIDIA was up a little over 37% for the last year, but gold is up over 38% in the same exact 12-month time period. And I think that's just surprising. I put that out there because obviously NVIDIA has just been the whirlwind stock the last year or so, but it's, as I just mentioned, it's corrected severely over $36 down from its high, and when we took the screenshot here, when I sent it to the team, it was down about 8% that day alone. And so what goes up can come down and often will, and it resets to the mean. Again, NVIDIA is an amazing company, has a huge history in front, based on its robust history, has a huge opportunity in front of it as AI becomes more prevalent and their chips are going to be needed. However, the hype typically gets a stock out of bounds. It gets it a little risk adjusted. And so the word of the day here would be caution. Heed caution. Do you understand, again, how much risk is in your portfolio? Are you comfortable if things reset? Because here's the thing, Chip. People forget. We've been about, other than COVID, right? We've been about 15 years in a bull run. We had a dip of about 22% in 2022, but it rebounded very, very quickly, and no one really felt that pain. So we've not had this capitulation moment in quite some time. Well, if you go back prior to that, 2007, 8, and 9, it was a 59% retracement, peak to trough, that happened in the markets, 59%. And in 2000, it was over 51%. So are you prepared for that? Or would you rather have someone show you how to maybe diversify your assets in a way? Maybe you're not going to get quite the same return, but you're going to have a risk-adjusted base return that can allow you to have income for the rest of your life. Are you protecting your assets? But so many people get excited by the past returns. Past performance does not guarantee future results.
Yeah. When the market's up 20%, maybe you're at 15 or 16%. But when the market goes down 20%, you will not be 15 or 20% down. More likely,
following our methodology,
more likely to be in the
so
single digits, maybe.
And exactly, we've talked about that. One of my clients who in town during the COVID drop, right, the market was down 37%. He caught, how bad is it? You're about like 6 or 7% or whatever it was. He's like, that's the best news I've had all week.
Right, right, because you preserve that nest egg. So when the inevitable upturn comes, you got more of it there to grow.
Yeah, and we cannot guarantee anything. We're not guaranteeing we can't lose money. But exactly, if we can mitigate the downside by understanding how to allocate your portfolio correctly, risk mitigation is key. And then the tax planning on top of that is what I think sets us apart.
That'll do it for this week. Please visit our website, retiresmartnow.com, and click Attend an Event at the top of the page to see everything we currently offer. No charge, no obligation for our events, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Well, let's hope that was the last of the snow. I don't want to put the blower away for the season, and my son doesn't want to shovel anymore. But have a blessed and prosperous week. We'll see you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.